Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 9, problems group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And so we're working on the last problem here for this chapter. And of course, this is the focus on decision making section. And it's about ratios, debt ratio and interest coverage ratio. So before I work these through, realize that you've already had these ratios back in Math for Business and Finance or Math Applications. Okay, so you can go back to that textbook or watch the videos under the Math for Business / Application section of the business group that cover working these ratios if you needed additional help on the theory and whatever have you. And also the ratios were covered in the theory videos for this particular chapter. So I'm just going to work through the problems and we'll be done with it. All right, so it says here, calculation of debt ratio and interest coverage ratio. All right, the classified balance sheet and selected income statement data for Quinn as of December 31st is presented next. And this is the selected income statement data. So Quinn's debt ratio and interest coverage ratio as of December 31st, round to 2 decimal places. And since I have just a small place here, I'll do 1, then pause the video, and then I will erase it, and then I'll do the other. Right, so we know that the debt ratio is equal to the total liabilities over the total assets, okay, which means the reason for the debt ratio is, do we have enough assets if we have to sell them off to pay off our total liabilities? Okay, and that's what we're measuring here. We, obviously we should have a positive number here, okay, a positive percentage. If not, we're in deep trouble here, right? We're upside down. All right, so let's see here. We have to look at our balance sheet, and we see our total. Let's see here. Our total, based upon this balance sheet, we have total current liabilities of $61,000. And we have total long-term debt of $173,000. And this is why I don't like using this single step format type of thing, because the authors did not write in here my total liabilities. Okay, I have to actually go and take the 61,000 plus the 173,000 and do the math myself in order to get the 234,000 for my total liabilities. That should be a number I should just be able to pick up off of the balance sheet. And as you can see, we have total stockholders' equity and then the total liability in stockholders' equity here. I should be able to add up this 234,000 here with a 91,000 here in order to get that number. But I can't do that just the way this information is presented. So I don't agree with the way it's presented on the balance sheet here. But it is what it is, and I'm explaining it, so just be aware of it. Okay. Whereas we have our total assets here of 325,000. So we divide one by the other, and we end up with 72%. Okay, so that's our debt ratio. Okay. All right. Just as an exercise on your own, play with these numbers. Okay. In order to get a feel and an understanding of why you're doing the debt ratio, plug in, instead of 234,000, plug in 100,000 and see what that percentage is. Plug in 300,000 and see what that percentage is, to see what happens when your liabilities increase or decrease and the effect on the ratio. And then also work the asset side of it, right? Take the assets and increase it to 400,000 and see what happens. Decrease it to 234,000, see what happens. Decrease it to 200,000 and see what happens. And this way you get a feel for how that ratio works and what it's supposed to represent. Okay, so with that, I'm going to pause the video for a second here, and then I'm going to erase so I could do the interest coverage ratio. All right, so I'm going to erase this. And for the interest coverage ratio, that is equal to earnings before interest and taxes over interest expense. Okay, the interest expense we're going to pick up very, very easy. We can come over to our income statement and find our interest expense. In this case, it's $18,700. Okay, I'm not going to go over the earnings before interest and taxes. Okay. Here it is telling you, they're giving you the $27,800, right? And so in order to do the calculation, we have 27,800 and we're dividing it by 18,700 and we end up with 1.49. And just as a quick aside before I get back to my spiel that I'm going to give here, again, just play with the numbers, increase your interest expense, decrease it. Doing the earnings before interest and taxes, that is not a line item that ends up on your income statement. Okay, you're not going to be able to just pick that number up real quick. All right, but all right, before I go there, all right, so also change that number up and down and see what the net effect is, just like I explained with the debt ratio. So change these two numbers and see the different effects in order to get a better feel for what the interest coverage ratio is trying to accomplish. But now I'm getting back to the earnings before interest and taxes here, right? Before the EBIT. Here they're just giving you the information, okay? And you just need to look up here and you see earnings before interest and taxes, it's 27.8. But that's not the way information is going to be presented in the real world. You're going to be presented an income statement, okay? And most often the earnings before interest and taxes is going to be your profit or loss, meaning you have revenues less your expenses, and then you'll have this here profit or loss. And I explained this back in the theory video, so go back and watch it again. But as to terminologies that are being used and how the terminology is interchangeable, but you have to understand where you're at in order to understand what that terminology means. You can't just blindly pick up a number. Like here, it's yeah, you're blindly picking it up because they're just giving it to you. But when you have a full income statement, you're not going to have that line item, and therefore you can't just pick one number. You're going to have to actually calculate it out. And when you're calculating it out, you're going to have to understand the structure of the income statement, because you're going to have interest up here in your revenue, in your interest expenses, and then you're going to have a line item here for your taxes here, and then you're going to have your net income here. Right? So you're going to actually have to do some calculations in order to arrive at the 27.8. Right? But I'm not going to go over all of that in detail because that's in the theory videos. So go back and watch those, and if you still don't get it, then feel free to telephone an instructor, but watch the videos. All right, so 2, what percentage of Quinn's assets belong to the stockholder? Right? So we just calculated the debt ratio, as 72%. Okay, so and notice that that's a percentage. The question is asking what percentage of assets belong to the stockholders. Right? Assets equals liabilities plus equity. Right? Now you can do this a number of different ways. Right? You can look down here and say, okay, my equity is 91. Come on. You could say my net equity is 91,000. My liabilities is the 234,000. And my assets are the 325,000. I can take, let me do it like this. I'm doing some math on the calculator, right? I can take and say, oh, right, because I know that the difference between my assets and liability is my equity, and I want to know what portion of it is, what portion of the assets belong to the stockholders. The difference between those two is this 91,000. So I can take that 91,000 because that's the remaining amount of the assets that goes to the stockholders, and divide that by the 325,000 and get 28%. Okay, so that's one way of doing it. Remember, this is 100%. Okay, and our total assets are 325,000. A portion of it is liabilities, which is 234,000, and a portion of it is 91,000. Right? So we want to know what portion belongs to, and percentage-wise, belongs to the stockholders. Dollar-wise, it's 91. To get the percentage, we take 91 and divide it by 325, and we get that 28%. That's one way of doing this problem, okay, based upon the accounting equation. Right? However, if I know my debt ratio is 72%, okay, if I take, and now we're working in percentages, okay, this here we were working in dollar amounts, and we convert it to a percentage. But here we're working as a percentage, and since the debt ratio is 72%, I subtract one from the other and I get 28%. That's the amount, obviously the same amount that belongs to the the stockholders, right? Because of the structure of the debt ratio being liabilities over assets. Okay? All right. Pause the video, write all of that down because I have to do 3 here. And I'm going to erase some of this. All right. So it says here, would you be willing to extend credit to Quinn? Why or why not? The solution says, based on the debt ratio and the interest coverage ratio, most people would not be willing to lend money to Quinn money because the total debt is 72% of total assets, and the earnings before interest and taxes only 1.49 times the interest expense. That is true. Okay. However, it doesn't. They're hedging themselves by saying most people would not. And to be honest with you, I can't make a judgment, okay, as to whether I would or I wouldn't. All right, for the simple reason, I don't have enough information, at least for my satisfaction. One, I'm only looking at one period of time here, December 31st. So I don't have comparables to see whether this, Quinn is either going up, or they're going down. All right. I don't know if their business is improving or decreasing. All right. So that's the first thing, because I don't have comparables. Right? I don't have nothing to compare it against. I only have one period. I don't have the previous periods for me to be able to make a judgment as to the stability of the company. The other thing, and this is getting a little bit beyond what's presented here as just plain basic financial accounting, is that I don't have, you're given investment choices. You're not given, you're not doing just, you can put your money into different investments, okay? And depending upon, I said, oh, I'm doing comparables period, from different accounting periods to just look at Quinn's itself. But what if I look at Quinn's and let's say I wanted to invest in the same type of business, the same sector, and let's just say XYZ company is in that sector and ABC company is in that sector along with Quinn's over here, right? Well, what does XYZ look like and what does ABC look like? I mean, if they're worse than Quinn's, and I definitely want to put my money into something, then maybe I would put it into Quinn's, okay? Because they're worse. But if they're better, well then, I would, choose the better one to put my money in. So I can't just say I would or I wouldn't invest in Quinn's. I have to be able to, excuse me, look at everything before I make my final decision, right? So while what the solution says is true, because it's just restating, the two ratios, and it just says most wouldn't. Well, that's not a good enough answer for me, okay? Because you don't just take it as at face value. You have to look at not only prior periods for the company, to be able to compare it and understand whether the 72% or the 1.49, what does that actually mean as compared to itself. And then I also want to look at the rest of the marketplace to see whether, I can put my money, it makes more sense to put my money in something else. I mean, if Quinn's is just is a little bit better than these other companies and I don't want to be in cash, then I would stick my money in that business, okay? If I wanted to be in cash, then I, depending upon what the other companies look like, and I don't like my return on investment for Quinn's, then I'd stay in cash, all right? It's never just that cut and dried as the solution had said. Okay, so with that, we're done with chapter 9 here. Again, if you don't understand something, go back and watch the theory videos. Bonds are a tough thing, all right? These here debt ratios, and the interest coverage ratio was covered in Math for Business and Finance before, so go back and watch the videos for that. Go back to that textbook. And you're getting it presented again in this chapter. So if you still don't, after watching the videos and working through the problems, you don't understand it, feel free to contact an instructor. All right, and I'll see you in chapter 10.